studying your last two. I swim with tea when they turned in. The staring down to mute and can learn the pole that sunk he died.
Now that we understand GRIP and eligible dividend capacity, let's look at one of the most important compliance rules in corporate tax planning. What happens when a corporation pays more eligible dividends than its available GRIP balance? The answer is called an excess eligible dividend. Think of GRIP as a speed limit for eligible dividends. In this example, the corporation has a GRIP balance of $216,000. That means the maximum eligible dividend it can safely pay is also $216,000. As shown on the left side of the slide, if the corporation pays $200,000 of eligible dividends, it remains within its available GRIP balance. Everything is fine. The corporation is compliant. No penalties apply, and shareholders continue to enjoy the favorable tax treatment associated with eligible dividends. This is the safe zone. Now let's look at the right side of the slide. Suppose the corporation declares $300,000 of eligible dividends instead. The problem is that the corporation only has $216,000 of GRIP available. As a result, part of the dividend exceeds the corporation's eligible dividend capacity. To determine the excess, we simply compare the eligible dividends paid to the available GRIP balance. $300,000 of eligible dividends minus $216,000 of GRIP equals an excess eligible dividend of $84,000. That $84,000 is the amount that creates the problem. And this leads us to the official definition. An excess eligible dividend occurs whenever eligible dividends paid exceed the corporation's available GRIP balance. Notice that not all of the dividend becomes problematic. Only the portion above the available GRIP is considered an excess eligible dividend. The comparison table at the bottom summarizes the rule. If eligible dividends are less than or equal to GRIP, the corporation remains in the safe zone. No excess exists and no penalty concerns arise. However, if eligible dividends exceed GRIP, an excess eligible dividend is created and the corporation becomes exposed to penalty tax. This is why experienced tax professionals always compare planned eligible dividends against the available GRIP balance before making any dividend declaration. The key takeaway from this slide is simple. GRIP is your eligible dividend limit. Any eligible dividends paid beyond that limit become excess eligible dividends. And once an excess exists, the corporation may face significant tax consequences. In the next slide, we'll calculate the actual Part III.1 penalty tax that applies when an excess eligible dividend is created and see how expensive this mistake can become. Now that we've identified what an excess eligible dividend is, let's see what it actually costs. This is where Part III.1 tax comes into play. Part III.1 tax is a special penalty tax designed to discourage corporations from paying more eligible dividends than their available GRIP balance allows. Think of it as a compliance penalty for exceeding your eligible dividend limit. Let's walk through the calculation step by step. As shown on the left side of the slide, the corporation starts with an available GRIP balance of $216,000. Next, the corporation declares $300,000 of eligible dividends. At first glance, this may seem harmless. But remember, the corporation only has $216,000 of eligible dividend capacity. To determine the problem amount, we subtract the available GRIP from the eligible dividends declared. $300,000 minus $216,000 gives us an excess eligible dividend of $84,000. That $84,000 is the amount that violates the GRIP limit. Once the excess has been determined, the Part III.1 tax formula is applied. The penalty is equal to 20% of the excess eligible dividend. In this case, we take $84,000 and multiply it by 20%. The result is a Part III.1 tax liability of $16,800. And that's a real cost to the corporation. Notice what happened here. The corporation did not earn additional income. It did not receive any additional cash benefit. It simply classified too much of the dividend as eligible. Yet that single mistake created a $16,800 tax bill. This is why the business owner shown on the right side of the slide is shocked when receiving the CRA assessment. From the owner's perspective, they believed they were simply paying dividends. But from the CRA's perspective, the corporation exceeded its GRIP balance and triggered a penalty tax. The impact section at the bottom illustrates the real consequence. An excess eligible dividend of $84,000 results in $16,800 flowing out of the corporation and into the hands of the CRA. Money that could have remained inside the business is lost because the GRIP balance was not checked before the dividend was declared. And this brings us to the most important lesson of this slide. Part III.1 tax is completely avoidable. The penalty only arises when eligible dividends exceed available GRIP. That's why professional tax advisors always verify the GRIP balance before declaring eligible dividends. A quick review of Schedule 53 can prevent a very expensive mistake. The key takeaway is simple. Exceeding GRIP can create significant penalties. In our example, an $84,000 excess dividend created a $16,800 tax bill. Always verify GRIP before declaring eligible dividends. A few minutes of planning can save thousands of dollars in unnecessary tax. In the next slide, we'll explore the good news. If a corporation makes this mistake, the tax rules provide a possible escape route through a special election under subsection 184(3), which may reduce or even eliminate the penalty. At this point, you might be wondering, what happens if a corporation accidentally pays too many eligible dividends? Is the Part III.1 penalty unavoidable? Fortunately, the answer is no. The Income Tax Act provides a potential relief mechanism known as the subsection 184(3) election. Think of this provision as an emergency correction tool that allows a corporation to fix an excess eligible dividend after the mistake has been identified. Let's revisit our example. The corporation declared $300,000 of eligible dividends. However, its available GRIP balance was only $216,000. This created an excess eligible dividend of $84,000. Without any corrective action, that excess would trigger a Part III.1 tax penalty of $16,800. That's the problem shown on the left side of the slide. Now let's look at the solution. In the center of the slide, the tax advisor guides the corporation across the bridge labeled subsection 184(3) election. This represents the corporation moving from a penalty situation toward a corrected tax position. The election allows the corporation to reclassify all or part of the excess eligible dividend as a non-eligible dividend. And that reclassification is the key. On the right side of the slide, we can see the process. Originally, the corporation declared $300,000 as eligible dividends. The excess portion, $84,000, is identified. That excess amount is then reclassified as a non-eligible dividend. As a result, the corporation is no longer treated as having paid an excess eligible dividend for that amount. In many cases, this can significantly reduce or even eliminate the Part III.1 tax penalty. The before and after comparison at the bottom of the slide illustrates the benefit. Before the election, the corporation faces an excess eligible dividend and a potential penalty tax. After the election, the excess amount has been converted into a non-eligible dividend. The excess is eliminated, and the penalty exposure is greatly reduced. However, this should not be viewed as a substitute for proper planning. The best outcome is always to avoid creating an excess-eligible dividend in the first place. That's why tax professionals follow the checklist shown at the bottom of the slide. First, review Schedule 53 and verify the current GRIP balance. Second, compare planned eligible dividends to available GRIP. Third, if an excess is discovered, file the 184.3 election as quickly as possible. And finally, ensure the dividend classification is corrected properly. The key takeaway from this slide is simple. An excess-eligible dividend does not automatically mean the penalty is permanent. Subsection 184.3 provides a valuable corrective mechanism that may allow the excess portion to be reclassified as a non-eligible dividend. But the smartest strategy is still prevention. Always verify GRIP before declaring eligible dividends, and use the 184.3 election only as a safety net when a mistake occurs. This is why experienced tax professionals view Schedule 53 as the first line of defense and subsection 184.3 as the emergency backup plan.